Elon Musk and Jeff Bezos are both titans of industry, and they're expecting a slowdown. They're expecting a potential recession, maybe even a global recession in the months ahead. Typically, when you see this does typically lead to a sharp stock market crash. The question is, if there is a recession, if there is a sharp stock market crash, what does that mean for you? How can you benefit from that dynamic? In this video, I'm going to talk what exactly Jeff Bezos, Elon Musk, what are they saying? And what are my thoughts on how you can benefit from this investment environment? Because I think a lot of folks are not prepared for what it's going to take. And so if this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. Please make a point of hitting that thumbs up, hit that subscribe button if you like learning about this type of content. So here it is, Jeff Bezos saying, yep, the probabilities in this economy tell you to batten down the hatches. He's responding to CEO of Goldman Sachs saying there's a good chance of a recession. This comes after Andy Jassy, who's currently running Amazon, effectively saying, yeah, we're going to put in some hiring freezes. We're going to be canceling warehouses. We're going to be closing some business. We're going to be cutting costs. This is super duper important because when you see a banker, when you see a tech entrepreneur and one of the largest tech companies in the world say, hey, potential recession, let's cut costs, it becomes self-fulfilling. You know, you might say, hey, there's going to be a recession. Well, now you're reinforcing it by doing things like layoff, by doing things like hiring freezes, where you're not enabling the company to effectively absorb potential job losses from other companies. And so if enough companies do that, you do get this sort of death spiral. And so this does, you can see how this starts leading to a recession. Now, Jeff Bezos, Amazon, he's not the only one. You see Elon Musk saying it sure would be nice to have 1 year without a horrible global event. Amen to that. So then Tesla owners of Silicon Valley go, how long you think the recession will last? He goes, just guessing, but probably until spring of 2024. So actually well over a year potentially. This fits with what Bloomberg economists say, saying they're looking at a 100% chance of a recession within a year. Personally, whenever I see economists saying one thing or another, I discount it. But when I see titans of industry saying it, then I put more weight to it. Another example, when you see the head of Goldman Sachs saying this, and also the head of JP Morgan saying the same thing, Jamie Dimon, once again, the self-reinforcing aspect, because they're the ones that help make loans. And so if they tell their underwriting, say, hey, let's tighten things up a bit. Let's make sure, we're super duper confident about the new loans we're going to make. That also slows down the economy. If you slow down the credit, that's effectively enabled. And so this does become self-reinforcing. The question is, well, do you think that it'll be a stock market crash? Well, even though Jeff Bezos and Elon Musk haven't explicitly said so, well, let's actually judge their behavior. And the reality is they've sold billions and billions of stock each. Now, they each have their own different reasons. Jeff Bezos now has his own, space ventures that he's looking to fund, and Elon Musk is looking to fund Twitter. But either way, sales at much higher prices for the enterprises that they historically didn't sell any shares in or weren't looking to trim their shares at all. So saying huge sales from Jeff Bezos at the end of 2021, November, literally billions of dollars in stock sales. And so the question is, okay, so if there's this likely recession, potentially even worse, depending on policymakers and how severe they want to make it, you have this recession, you potentially have a stock market crash. The question is, what happens from here? Well, first, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. In full disclosure, this is not financial advice. So there's a couple of things that you should know. Paul Tudor Jones was actually even talking about this earlier this week. Paul Tudor Jones, just for full reference, he's a billionaire, very, very successful hedge fund manager. He actually called the 1987 stock market crash and shorted it before it happened. So when he talks, I definitely want to hear what he has to say. So he says, hey, I'm pulling open my recessionary playbook. And one of the things he does is he's looking at the short end of the yield curve, or the front end of the yield curve, looking at what U.S. Treasuries are doing, particularly 2-year, 3-year U.S. Treasuries. And you can see how the yield on 2-year Treasuries, so Treasuries that mature within 2 years, what the yield has done over this past year or year to date, how it's gone from around 0.7% to around 4.5%. That's a dramatic increase. And this is largely due to the Federal Reserve saying, hey, we are going to combat inflation. So they're raising short-term rates. They're raising the Fed funds rate, which trickles to, the 2 and 3 year yields. And so you're looking at this. And so this has become much tighter, and this will constrain the economy. This is sort of becoming the cost that all these companies, when they borrow money, it's now gone up significantly, a couple percent. And what he said is, let's look at this 2-year, 3-year yield. And when that starts coming down, that might be a sign of a bottom. Now, we're clearly not showing that yet. So you might have some false bear market rallies. We are not seeing that yet. Now, the reason why he says that you would want to look at that for a potential bottom with stocks is because what's currently happening is the Federal Reserve wants to crush inflation. At least that's their stated goal. As long as they stick to that stated goal, they're going to keep raising rates and keep tightening, keep trying to trim down their bond portfolio, keep tightening monetary conditions, with the goal that if they tighten enough, they will crush inflation. And the expectation is that, well, there's two sides to inflation. There's supply and there's demand. Well, the Federal Reserve can't really control supply, so they'll try to crush demand, which ultimately means higher unemployment. And so when you reach a point where the Federal Reserve has crushed demand so severely and unemployment is picking up and inflation is now tempered, now maybe 2%, maybe 4%, maybe 5%, but it's lower than the 8-9% that we've recently seen. When you see that happen and you see the economy really starting to fall apart, which I think something will eventually break with the Federal Reserve raising interest rates, when you see that happen, you should see in the markets start pricing in that they will back off and that they might even consider lowering rates to help a stumbling economy. We are not there yet. And when they do that, however, you will see something where the 2-year Treasury yield will start going down in anticipation of the Federal Reserve backing off and saying, hey, it's time to start easing because the economy is suffering and inflation is now moderating or in control. That is not what's being priced in right now. Right now, it's saying, hey, we are still raising rates and still monetary tightening ahead. Another key aspect that I think investors need to consider, because what we're effectively saying is so far, the stock market is down because of higher interest rates, which should impact lower valuations, should drive lower valuations. But we haven't seen the other shoe to drop. We haven't really seen the recessionary impact. We haven't seen earnings decline by 20, 30%, which sometimes happens. When you see that economic impact from the fact that demand is slowing down. Now, when you see that, then arguably you see even lower prices in the stock market. Now, when is the time to buy? What's the right price to buy? And so let's look at Microsoft as an example during not the great financial crisis, but actually going back to the dot-com bubble, going back to the end of 2001 to 2012, the beginning of 2012, where you could see that they absolutely crushed it. And I think this is a super important lesson. If you are investing in the market, I think this is a critical lesson that you should be able to teach someone else. So not only listen to what I have to say, you need to internalize it and be able to teach it to someone else. So that way, when you're investing for yourself, you understand what it's going to take. You need to be able to say to yourself, oh, this is what I'm looking for. Now, number one, you want something with fundamental earnings power and fundamental growth over time. So that's what historically Microsoft had from 2001, let's say, to 2012. Earnings grew by roughly 4x, from around $6 billion in net income to around $24 billion in net income. That is a 4x increase. So one would expect, well, Microsoft should do well over a decade-long period. But that is not actually what happened. Over that decade-plus period, Microsoft stock actually went down. Okay, so you need to understand earnings power can be priced in. That future growth can get priced in. You need to make sure that you're paying the right valuation. Otherwise, you're going to have a period like this where you buy things, oh, this is a great company, but it's priced in and over the next decade, plus you actually have a nothing burger, a nothing of a return. And even if you dollar cost average, this would have been a terrible return. Imagine dollar cost average, oh, year after year after year after year, 2001, 2002, 3, 4, 5, 6. This would have been a terrible investment for this period. Now, when did it improve? It improved when you were able to start looking at lower valuations. And this is arguably why did the stock go nowhere during this time frame when earnings went up? Well, it's because the underlying earnings multiple went from 60 times roughly to around 10 times. That's the crux of it. So the core lesson, in my opinion, that this is, in my opinion, how you can crush the upcoming recession is to find these amazing businesses. Find the businesses that you have high conviction will be multiples bigger 5-10 years from now. But have the discipline, and this is where a lot of people are going to completely whiff, have the discipline to pay, let's say, 10 to 20 times free cash flow. Because when you pay that 10 times free cash flow or 20 times free cash flow, and they're returning that free cash flow to you, at 20 times free cash flow, you're effectively getting a 5% yield. So over time, 5% yield plus, let's say, 5 to 10% organic growth, you're going to get 10, 15% annualized return. Much better than the market over time. That's what you want to get. So that's the core challenge. And if you think, you're looking at some exceptional businesses, make sure you check yourself with how that valuation is. Now, recently I called out to my Unrivaled Investing subscribers, let's say a payments company, one of the largest payments company in the world. It's come down a bit. It's still growing 20, 30% a year. Now it's trading around like 25 times earnings, forward earnings. So I'm starting to buy it. It's starting to get interesting. It's not quite at that 20 times where I'd say, oh, okay, now let's make it a big bet. But that's exactly what you want to try to find. You want to find these things where you're saying, hey, this is now at that free cash flow multiple where I can say, even if, let's say the business is flat because there's an unexpected or the recession is even tougher than I expected, even if the business is flat, I'm getting that free cash flow yield. If investors had done that with Microsoft, as I'm sure you're aware, Microsoft since then has been an amazing company. Now, partly that's because you had a change in leadership, but also a big part of that is because the valuation was so low at under 10 times free cash flow, around 10 times free cash flow. So that's a key lesson to consider. If you have different thoughts or other thoughts, or you think there are some great high growth companies trading at 10 to 20 times free cash flow that you know about, that you want to call it, that you think are not cyclical, that is the key aspect. It has to have stable earnings power, because if it's cyclical, it's trading at 10 times earnings. Oh, wait a second. The economy falls apart. Now it's trading at 30 times earnings because their earnings fell off a cliff, or now it's trading at 50 times earnings because its earnings fell off a cliff. That is the concern with a lot of these businesses, especially businesses that have one-time sales, effectively where you're selling, maybe it's a car, maybe it's just selling, a product where you don't have that recurring revenue, like a software business or something like insurance or medical product, subscription. So that's arguably what I'm looking for. And that's the challenge that a lot of these businesses are going to face with this upcoming recession and potential stock market crash. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. And thank you so much for watching Unrivaled Investing.